Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm Sandy, your guest host from Keller Williams Legacies, here to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hamoen here. This is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
So, Steve, let's kick things off by talking about the current situation in Ontario's condo market. There's been a lot of buzz about a glut and a building crisis. What are your thoughts on this?
Well, Sandy, experts are pointing out that Ontario's condo market is indeed facing a significant glut. There are more condos being developed than the demand can currently support, leading to a saturated market. This is a complex issue with multiple factors at play, including the economic climate and changing buyer preferences.
It sounds like a challenging situation for developers and investors. But what about the home buyers? How does this affect them?
For home buyers, this situation can be a double-edged sword. On one hand, the surplus could mean more options and potentially lower prices as developers try to offload inventory. However, there's also a risk of investing in a property that might not appreciate in value as quickly as one would hope would.
That's a good point. I read that some experts suggest this glut is partly due to a mismatch between the types of condos being built and what buyers are actually looking for. Can you expand on that?
Absolutely, Sandy. The market has seen a surge in luxury condos, but the demand seems to be stronger for more affordable housing options. Many first-time buyers and young families are looking for something within their budget, and the high-end condos don't necessarily meet their needs.
It makes sense. People are looking for homes they can afford, especially with the cost of living on the rise. So, what are developers doing in response to this situation?
Some developers are starting to pivot towards constructing more affordable units to align with market demand. However, this shift takes time, and there are regulatory and financial hurdles that can slow down the process. It's a delicate balance between meeting current demand and planning for future market conditions.
It's a tricky situation indeed. But what about the building crisis? How is that impacting the condo market?
The building crisis, Sandy, is largely tied to supply chain issues and rising construction costs. These factors are causing delays and making it more expensive to complete projects. This not only affects the timeline for new condos coming to market, but also impacts the pricing. Developers are facing increased pressure to maintain profitability while still delivering on buyer expectations.
That's a tough spot to be in for developers. Sounds like the condo market is in a bit of a transition phase. It'll be interesting to see how things evolve in the coming months.
Definitely, Sandy. The market dynamics are shifting, and it will require careful navigation from all parties involved, developers, buyers, and policymakers alike. Staying informed and adaptable will be key.
Let's shift gears and talk about the recent audit report by Ontario's Auditor General that flagged some serious issues with the Home Construction Regulatory Authority, or HCRA. The report suggests that new home buyers might be at risk due to insufficient oversight of builders and vendors. Steve, what are your thoughts on this?
Sandy, the report is quite concerning. It highlights that the HCRA has been approving over 99% of license applications without placing any conditions on them, even when the applicants had financial issues or a history of conduct problems. This lack of scrutiny could indeed leave homebuyers vulnerable to unreliable builders.
That's alarming, especially when you consider the scale of investment involved in buying a new home. The audit also pointed out that many licenses were renewed through a fast-track process, bypassing thorough staff reviews. In 2024 and 2025, 134 licensees with open complaints, including those classified as high risk, were renewed without proper evaluation.
Exactly, Sandy. One of the most striking cases was a builder who received a fast-tracked renewal just days before being hit with $16 million in penalties for numerous breaches of the Code of Ethics. Despite entering receivership, this builder still held an active license, which is a serious oversight by the regulatory body.
It seems like the HCRA is relying too heavily on credit scores for assessing financial responsibility, and even then, they're approving applicants who don't meet their own credit thresholds. This practice doesn't offer much reassurance for homebuyers, especially as Tarion, the home warranty provider, reported a significant increase in deposit protection claims and builder insolvencies.
That's right, Sandy. The audit found that in 2024, Tarion paid out $76.9 million in deposit claims, which is more than the previous 3 years combined. This indicates a growing issue with builder reliability, and the HCRA's oversight seems to be more reactive than proactive, largely responding to complaints rather than preventing issues from arising.
The backlog of open complaints has ballooned from 129 in 2021 to over 1,500 by March 2025, with complaints taking an average of 419 days to resolve. That's a long time for homebuyers to wait for resolution, especially given the financial and emotional stakes involved in purchasing a home.
Absolutely, Sandy. The Auditor General also pointed out that the HCRA isn't utilizing municipal building permit data to identify illegal builders, which is a missed opportunity to prevent unlicensed activity. With the average price of a new Ontario home reaching over $790,000 in 2024, reliable regulatory oversight is crucial to protect both buyers and lenders in this market.
On a brighter note, the HCRA has agreed to implement all 10 of the auditor's recommendations to strengthen their controls and review financial assessment practices. The Ministry of Public and Business Service Delivery and Procurement also accepted most recommendations, although they're cautious about mandatory continuing education and technical competency standards due to potential impacts on housing supply.
It's a step in the right direction, Sandy. Strengthening oversight and ensuring builders are properly vetted is essential to maintaining trust in the housing market. It'll be interesting to see how these changes are implemented and whether they effectively address the concerns raised in the audit.
Steve, let's take a look at the recent report from Oxford Economics on the Canadian housing market. According to the report, we're not looking at a boom or bust scenario for home prices in the near future. Instead, there's an expectation for prices to remain relatively flat through 2030. What are your thoughts on this projection?
Well, Sandy, it's an interesting forecast and one that seems to be driven by a few key factors. The report highlights that the chronic undersupply in the market is likely to provide a floor for prices. Even as new supply gradually comes online, it appears that the fundamentals will prevent any significant downturn in prices. This is crucial because it suggests stability in the market, even amidst economic uncertainties.
Stability is definitely a positive sign, especially for homeowners and potential buyers who are wary of drastic price changes. But the report also mentions that the elevated house price to income ratio is going to limit any significant price increases. This seems to reflect a broader affordability challenge that we're seeing in major metros like Toronto and Vancouver.
Absolutely, Sandy. The lack of affordability in these large metro areas is a persistent issue. The report points out that prices in Toronto and Vancouver are expected to slide further before stabilizing. This is partly due to lackluster investor demand, especially in the condo market. However, in other regions like the prairies and eastern Canada, we're seeing more resilience, which is good news for those markets.
It's fascinating how regional differences play such a significant role in the overall housing market landscape. While some areas are experiencing declines, others are holding strong. The report also noted that affordability improvements might stall as fixed rates edge higher and prices find a bottom. That could be a tough pill to swallow for those hoping for more accessible entry points into the market.
Certainly, Sandy. The interplay between interest rates and affordability is a critical aspect here. The Bank of Canada's recent rate cuts might encourage some activity in the market, but as the report suggests, listings are expected to rise faster than demand, especially with the labor market showing signs of strain and population growth slowing. It's a complex scenario that requires careful monitoring.
And speaking of monitoring, The report also flagged some downside risks, like a potential global trade war or financial market correction, which could impact the housing market. It's a reminder that while the baseline forecast is for stability, there are always external factors that could influence the trajectory.
Exactly, Sandy. It's about preparing for a slow recovery rather than expecting a dramatic rebound. The chronic undersupply and policy support, such as government programs like the Build Canada Homes Initiative, are expected to cushion the market against a crash. However, the affordability challenges and regional disparities will likely persist, so it's important for market participants to remain vigilant.
We're seeing an increasing number of Canadian seniors feeling the financial pinch, especially when it comes to supporting their families with housing costs. According to the 2025 Aging and Affordability Insights Benchmark Report from Bloom Finance, 76% of seniors who provide financial help to their children or grandchildren say it's impacting their retirement savings. That's up from 65% last year. Steve, what do you make of this trend?
Sandy, it's a significant jump and highlights the growing financial strain on seniors. The report shows that intergenerational support is still very much a part of Canadian family life, but the economic pressures are making it harder for seniors to balance their generosity with their own financial security. It's a tough situation where their well-being might be at risk.
It's definitely a balancing act. The report also notes that 28% of those providing financial support are helping with rent or mortgage payments, which is slightly up from last year. Meanwhile, a majority, 67%, are covering everyday living expenses. This increase is quite significant compared to the previous year. It shows just how much more seniors are stepping in to help.
And it's not just about the immediate support, Sandy. The BMO survey indicates that a substantial number of Canadian parents and grandparents are planning to continue this support in the coming year. This expectation can put even more pressure on their retirement savings, especially when housing costs are rising.
Anthony Tintinelli from BMO emphasized the importance of striking a balance between supporting family and protecting one's long-term financial health. It's a delicate issue as 30% of those supporting family have seen a significant impact on their savings, and 61% are planning to adjust their lifestyle or spending habits. That's a big change for many.
It is, Sandy, and some seniors are considering downsizing or taking on part-time work to cope with these financial pressures. Tracy Valco from Valco Financial suggests right-sizing as an alternative, essentially adjusting one's living situation to match current financial circumstances rather than downsizing out of necessity. This approach could help alleviate debt and offer a fresh start.
Right-sizing might be a more palatable option for seniors who are already stressed by managing debt. The report also found that 58% of seniors plan to spend less than $1,000 this holiday season due to rising costs, which is up from 48% last year. It reflects how deeply these financial challenges are affecting their everyday decisions.
That's true, Sandy. The financial burden is prompting significant lifestyle changes among seniors. It's crucial for them to have access to sound financial advice and support to navigate these challenges effectively. We need to keep an eye on how these trends develop and ensure that the support systems in place are adequate to help seniors maintain their quality of life.
Now let's delve into the Bank of Canada's recent decision-making process regarding interest rates. According to a Bloomberg report, the Bank of Canada considered holding rates steady in September due to strong household consumption and trade uncertainty. However, they ultimately decided on a rate cut. Steve, what do you think led to this decision?
Well, Sandy, the decision to cut rates to 2.5% was influenced by several factors. The economy and job market had been adversely affected by a trade dispute with the United States, leading to contractions in exports and business investments. Despite this, there was strong momentum in household consumption, which initially suggested that holding rates might be a viable option.
It seems like a delicate balance between supporting economic growth and managing inflation. The report mentions that past interest rate cuts may have contributed to the strength in consumer spending. How does this play into the bank's considerations?
That's right, Sandy. Consumer resilience has been a key factor in supporting growth. The bank noted that consumption growth was not only strong, but also broad-based. This indicates that previous rate cuts have had a positive impact on consumer spending, which is crucial for economic stability. However, the bank also had to consider the broader economic picture, including signs of a weakening economy and more contained inflation.
The report also highlights that Prime Minister Mark Carney's decision to drop retaliatory levies on some U.S. imports removed a significant risk to Canadian consumers. How do you think this affected the bank's decision?
Removing those levies certainly eased some pressure on consumers by potentially reducing costs. It was a move that likely contributed to the bank's confidence in consumer spending, even though they acknowledged that inflation pressures were easing. This context helped justify the rate cut as a means to further support the economy without exacerbating inflation risks.
It's interesting how these policy decisions intersect with economic conditions. The bank's deliberations also pointed out that the upside risks had diminished but not disappeared entirely. What are some of these risks?
The bank noted that trade disruptions were a major concern, as they increased costs and affected the efficiency of the economy. The uncertainty regarding how and when U.S. tariffs might impact Canadian consumers adds another layer of complexity. The bank is proceeding cautiously, aware of the risks to inflation from both sides, which means they can't afford to be complacent.
It's a challenging environment to navigate for sure. The report also mentioned that the bank hasn't provided a conventional set of point forecasts since January, and instead opted for multiple scenarios. How does this approach help in managing expectations?
By laying out multiple scenarios, the bank acknowledges the volatile nature of the current trade policy environment. This approach allows them to communicate the uncertainty and prepare stakeholders for various outcomes. It also underscores the complexity of monetary policy in the face of structural shocks, like the ones posed by trade disruptions.
Thanks for that insight, Steve. As we wrap up today's episode, it's clear that the Bank of Canada's decisions are intricately linked to both domestic and international factors. It'll be essential to keep an eye on these developments as they unfold.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your home ownership goals. Catch you next time, and stay informed with the latest industry insights.